Hello, my name is Benjamin Z. Miller, and I am the managing director of a United Kingdom company called Alamo Mortgage Holdings. Alamo Mortgage Holdings is a company that invests into purchasing American mortgage debt. We do this with our bondholders, where our bondholders can earn a significant long-term passive income when they purchase one of our corporate income bonds. I'm going to go through a presentation today that shows how this works, but first I want to read a disclaimer, just an excerpt of a disclaimer. As accredited investors, you will be aware that all investments carry some level of risk. This investment is only available to investors who are able to assess their own appetite for risk. Please read the risk statement within the investment memorandum before investing. All right, well, fantastic. So let's talk about the United Kingdom, and let's talk about the United States and the history of the exchange rate between the two countries and how this might be important if you're a UK investor and most of your currency is in British pound sterling. Because there's quite a difference between earning an 8% return in British pound sterling and 8% return in US dollars. It can be a tremendous difference when you factor in the exchange rate. Towards the end of World War II, there was the Bretton Woods Agreement, where the exchange rate between the British pound and the US dollar was fixed at approximately 1 British pound back on the 27th of December, 1945. It purchased $4.03 US. And over the years, over the decades, the pound has lost value and the dollar has gained value over many, many decades. So if we went to, say, the year 1967, 1 British pound only purchased $2.40 US. And if we went all the way to the 1st of January 2023, the British pound, 1 British pound only purchased $1.21 US. So what does that mean if you're looking at investments and you're thinking, well, I could get 8% in the US or I could get 8% in the UK? It needs to be thought about, because if you're in a currency that is increasing in value, this can be a benefit to you. And if you're in one that's decreasing in value, it can be a detriment. So how do we pay 8%? Well, we actually do this by, we purchase mortgage debts at a discount. In the United States, we purchase packages of mortgages at a discount. And that allows us to pay our bondholders a hefty sum. We're able to pay 8%. So it is a fantastic opportunity. We might purchase a mortgage note that has a value of $100,000 unpaid balance. We might purchase it for cash, $70,000 US. That mortgage note may have been paying a 10% interest rate when it was originated, but since we purchased it at a discount, the yield on that note has actually increased to 14.2%. And I've included a chart here that shows the calculation of yields. It's just the annual cash inflow from the investment divided by the market price of the investment. So what determines the value of a mortgage note? Sometimes people think, well, you know, that sounds good, buying debt. Maybe I should do that. Well, if you're going to buy debt, you should be educated about it. And there's 6 primary factors that determine the value of mortgage debt. The first is the buyer that is guaranteeing the debt. So, for example, if you have 2 buyers, one of them is purchasing a property and going to make payments over time, and that buyer works for some government agency. Maybe they work at the post office. Maybe they have a cushy, soft job at the post office. Versus another buyer that's maybe a younger person that has a dream of setting up a competitor to Facebook. They're only 22 years old. They don't have a regular income, but they think they're going to make millions of dollars. If you're looking at which buyer is more likely to pay you on time, it's going to be the older postal worker that has worked at his government job for many years compared to the founder of a tech startup. Second factor is the collateral. Basically, you need to know what is the asset what's the asset worth? What's the property worth? Let's say the property is worth $100,000, but there's a note floating around for $200,000. How in the world could that happen? Well, maybe if you're in the state of Texas, what happened was you had a seller that met a buyer at a bar, and that buyer was from California and did not know the prices. And the California guy said, hey, you know, I want to buy a property. And the Texas guy said, "Oh, I've got a great property. I'll sell it to you. It's only 200,000. It's a good deal." And the buyer didn't have a real estate agent, didn't know. To him in California, the prices are much higher. 200,000 seems cheap. He went ahead and bought it, even though he paid twice the market value. Well, that does not make the note worth 200,000. You have to look at what's the actual value of the collateral. The down payment, did the buyer put down a large down payment or did they put down a small down payment? All other factors being equal, a note that has a larger down payment is far, far less likely to default, and you're far less likely to have problems if you buy a note that had a large down payment. What about the terms? For example, if you had a choice between a note paying 5%, a mortgage note that paid you 5% versus a mortgage note that paid you 10%, the note that pays 10% is more attractive. What about the history? The history of the payments. Well, were the payments third-party serviced? Was there a company that looked at the history of the payments that is verifying that? Or is the seller of the note simply giving you an Excel spreadsheet and telling you that, yes, they pay on time, they are very reliable? The paperwork, was it closed properly with attorneys that drafted the legal paperwork, or was it just done by two guys that used LegalZoom? So these are kind of the factors that need to be looked at. Here's an example. This is a real property. It's not one that's in our portfolio, but it shows the idea. It illustrates it well. Let's imagine that this property is being sold for $120,000. That's actually the price it was being offered for when I took this example. And let's imagine that a buyer came forward and said, "Hey, I like this property. I want to buy it. I'll put down $20,000." And the seller said, "I want you to pay all cash." And the buyer said, "Well, I don't have all cash. I've only got $20,000. And the seller said, "I want you to go to a bank and get a loan and then come back." So the buyer went to the bank and the bank said, "We're not going to give you a loan. You've got a bad credit score and you're self-employed." So then the buyer went back to the seller and said, "I can't get a loan, but I can pay 20,000 cash." And finally the seller, because they're moving out of town, they don't have a lot of time, and they really want to get their full price, they agreed to do it. They agreed to take payments over time, but they say, you know, instead of financing at a bank rate, I want 10%. So I'm not going to finance to you at 5% like a bank might. I want 10%. So this is how this sort of thing happens. Now imagine that the monthly payments are $877.57 per month. Let's imagine that this particular buyer is very reliable and is paying every month on time. The seller wakes up one day and needs or wants cash. The first thing the seller does is they call up their buyer and they say, "Hey, can you go get a mortgage? It's been 5 years. I'm tired of waiting. This is ridiculous." And then the buyer says, "A bank still won't give me a mortgage because I still have bad credit and I still am self-employed." So then the seller, the next thing he does is he gets on the phone, calls around, and he gets the idea that what he's going to do is find a company that buys mortgage notes. So he jumps on the internet and he types in "sell a mortgage note for cash," and a company like Alamo Mortgage Holdings appears. He calls up a company like Alamo Mortgage Holdings and he says, "Hey, I've got a note. It has an unpaid balance of $96,574. I want to sell it. Will you pay me $96,574? So Alamo says, "Well, you know, you didn't quite have all this perfect in the paperwork. We're going to offer you," for example, let's say that Alamo would take a 12% yield. We buy it at a discount, say $83,322.39 would be the maximum. But by getting those higher yields, it lets us pay our bondholders significantly more, where they can enjoy the passive mailbox money without any of the hassles. So here's an example. We're not normally focused on purchasing package. We're trying to purchase packages of mortgage notes, not individual notes. So here's an example of what a package looks like.
So this right here is actually an example of what a portfolio of loan notes might look like. So this is actually a real portfolio, and you look here and you can see the name of the borrower, the number of months. You can see the interest rate. This debt is actually pretty high. 14.75% is what they're paying on that mortgage. The monthly payment is $278.50. Then you can see the terms, the status, this sort of thing. So, I mean, you've got a list here, and this is an example of a package where a package of these mortgages can be purchased. This type of deal would be done by a larger investor. It would not typically be a single investor that would buy this package. For example, my company, Alamo Mortgage Holdings, this is the type of package that we might actually purchase, something like this. But if you're just starting out in investing, you might start out by, you're just going to buy one mortgage note. So for example, you might come in and this mortgage note, if you find something like this out on the market, you might try to negotiate down from, the unpaid balance at $89,570. Maybe you try to buy it for $59,000 or $69,000. But that would be one note. But you can also purchase packages of notes. And that's something that Alamo Mortgage Holdings is involved with.
So that's how that works. That's exactly how that works and what that looks like with packages of mortgage notes. So now sometimes I'm asked the question, well, why bonds? Why would I buy bonds when there is inflation? There's inflation. Why in the world would I buy bonds? Well, good question. Rather than giving my opinion, I'm going to talk about a Nobel Prize winning economist, Harry Markowitz. And if any of you have accounts at Merrill Lynch or BlackRock or any of these well-known firms, they just love some of the work that Harry Markowitz did. He actually is the grandfather of portfolio building. He won the 1990 Nobel Prize for Economics for his contributions to modern portfolio theory. And BlackRock and Merrill Lynch, they just lap this up. They just love that modern portfolio theory. And basically, the concepts are you're going to divide a portfolio and all of this, and there's a lot to it. But essentially, it's the interesting part of this story is not what they're doing. What's interesting about it is to look at what Harry Markowitz would do with his own personal portfolio. So all of the geniuses over there, they're doing their thing. But Harry Markowitz, the one that so much of what they're doing, the work they do is based on, he did it much differently when it came to his own portfolio. He preferred a simpler method. He would put half of his money in stocks and he'd put half of his money in bonds, and once a year he'd adjust his portfolio. And the reason he did that was he knew he couldn't predict what the market was going to do, what the crowd is going to do. And despite every day trader that thinks that they're amazing because they pull off a few lucky trades, eventually they get knocked out. Well, he would just adjust the portfolio once a year. So if the stocks had gone up a great deal in value, he would sell some stocks and he'd buy more bonds. Or if vice versa, if the stocks had gone down in value a great deal, he would sell some bonds and he would buy more stocks. It was a very simple system. And that was what he actually did. Another question that we're sometimes asked is, why Texas mortgage debt? Well, Texas mortgage debt has a lot of advantages because Texas is a state that is winning. We've got people coming in from California. We've got people coming in from New York. And when those people move into Texas, it makes the value of the real estate more valuable. And our collateral is real estate. So when our collateral increases in value, that's a good thing for us and a great thing for our bondholders. So that is basically how that works. What are the key features of our bond? Well, first of all, we can help you reach your passive income goals far, far more quickly than you working alone, likely. And with this, the way that it works is we determine you tell us. You say, what is your retirement goal? What is your passive income goal? What number would you like to get to? Let's say it's 5,000 pounds a month. Maybe it's 10,000 pounds a month. Maybe it's only 2,000 pounds a month, whatever it is. We then work back with a calculation, and we can do this for you. We provide this at no cost. It's completely free. How you would get on an annual investment program. And we say, okay, how many years do you want to until you reach that? Maybe that's 10 years, maybe that's 5 years, maybe you've only got 2 or 3 years, whatever it might be. We work with you on that. And then we come up with an annual investment program that can get you to that to that passive income goal. It's very simple. It's an ideal way to do it. Another advantage is you get maximum diversification compared to trying to do this on your own, where you have to learn a lot and you have to do a lot of work and negotiating and figuring all this stuff out. We've got a team in place, and I'll talk about the team in a minute, that does all that for you. No fees. I hear people all the time, they are so proud of their index fund and they say it's a low fee index fund. If I hear that one more time, I don't know what I'm going to do, but I've had enough of it. No more of this low fee index fund. How about no fees? Does no fees sound better than low fees? I think it does to most intelligent people. We don't charge our investors any fees. So don't, please, on the low fee index funds, I've heard that enough. No fees is better than low fees. Most people would agree. And I want you to think about that, you know, because when you invest with Alamo, when you purchase one of our bonds, you are not paying any fees. We designed it that way. We make our money when we negotiate with the sellers. We don't try to make the money on the back of our bondholder by charging them a bunch of fees or low fees. So a lot of advantages there. About myself, I'm a businessman. I've done real estate many years in the US and Europe. I've also studied a lot about mortgage investing. I've done that myself for many years. We've got Marina Zaharelska. She is our international investment coordinator. She is so talented. She speaks multiple languages. She's a graduate of the EU Business School. We've got Scott Wynn, who's a veteran of the mortgage note industry. He's got 30 plus years experience buying mortgage notes. He's an expert at debt, and he's really good at what are called workaround situations, where you buy some debt and it's not producing income. He can make it produce income by restructuring the debt. Fred Hobbs, who is our director of mortgage servicing. He has been a licensed mortgage originator and he's originated millions in mortgages. He also has a company called Secure Net Loan Services, and they are the best. They are a servicing company, and Alamo Mortgage Holdings highly recommends them. They do all of the servicing for our notes. That means collecting, making sure the taxes and the insurance are paid. We have David Jones, who's the in-house legal counsel for Alamo Mortgage Holdings. He's a third-generation attorney in the state of Texas, and just an extremely talented attorney. We have Mark DeRuyter, who is our chief technical officer. He makes sure that we keep everything in compliance with all of the IT and all of the programming issues. Very talented. We have Andrew Richings, who's in the United Kingdom. He's a UK citizen. He's the founder of Thomas Kelly Holdings, which is a boutique private consultancy firm that is focused on private equity and fixed income bonds for ultra high net worth and high net worth investors. He helps us with everything at Alamo Mortgage Holdings in a consulting capacity. Great guy. I highly recommend him. So let's go through a few questions, then we'll end this. Why should you invest in the notes? If you want an above average return, if you don't want to just get that low index fund and sit there without thinking, Alamo Mortgage Holdings can help you. How long is the note term? We offer a note term that ranges from 3, 5 to 50 years. Can you put the note into your SIP? Well, I see no reason you can't. It ultimately is up to your SIP provider, but you can check with them. And if they don't understand what we're doing, we'll be happy to talk to them about it. What type of an investment is it? You're purchasing a corporate income bond, not a government bond. Is it a regulated product? No, and that's part of the reason we can pay such higher rates. We haven't had to go through the additional expense and burden of regulation. Who can invest? An accredited investor, a sophisticated investor, a company, a trust, come one, come all. Are joint applications permitted? Yes. How's the money protected? We have a variety of things that we do on that, and we can go through that on a one-on-one call. Okay, very good. How's the tax managed? We pay all the money to you. We don't deduct anything for taxes. Are there any limits on how much you can invest? No, and we can support very large placements from institutional investors. Can you get access to the money early? No, this is not like day trading where you can log on to your brokerage account and click some buttons and, oh, you know, it's going down, I better sell at a loss. It's not like that. Frankly, that day trading doesn't do any good for anyone in general. Most of the people that do that day trading, they just lose money. You're better off in investing if you just place the capital and wait over time. It usually works out better. So this is something where you can get a great return over many years, and it's going to beat out all of the daredevils that want to try their hands at cryptocurrency trading and that want to try the day trading. How do you receive the interest? We just pay it to whatever bank account you nominate. How do you invest? Just get in touch with us. Go to our website, alamomortgageholdings.co.uk, fill out the contact form. We can get more information to you. We can also schedule a one-on-one call. I hope that helps, and I wish you good luck with your investing.